Olix Network 18, Mission Poshan, Bhavishya Roshan.
Equity backdrop, and we have actually a very special guest this morning. He's an Oxford doctor in laser physics who chose to switch the path from academia to high finance. Bill Maldonado, the chief global strategist at HSBC, is best known for pioneering HSBC's early stage move into hedge funds in 1999. Bill likes to think of himself as a potent mixture of science and art. Given his penchant for both disciplines, actually, he loves riding high-powered Ducati motorbikes or even piloting a light aircraft. Bill Maldonado, it is a pleasure to have you with us this morning. I'll stick with your first name and begin talking about US growth. Well, you know, it's firing up as the latest jobs data showed us Friday. Do you see, therefore, globally, smart money going a bit away from EMs and towards DMs, towards USC?
I don't think so. I think that the risk-reward now is much more in favor of emerging markets and what I would describe as the late cycle developed markets. So we've got further to go on the economic cycle in those markets, and we have better prospects for corporates and particularly for the profitability of corporates in those markets. And indeed, what we've seen is that emerging market economies have been outperforming developed market economies in terms of growth, and the markets have been outperforming in terms of returns as well. So no, you know, in answer to your question, no, I think that investors are going to increasingly find the growth prospects that are offered by emerging markets more attractive, and are going to continue to invest there versus the US.
Okay, that's good to hear, but let me persist with the counter arguments. The record highs achieved by US stock indices, you know, either NASDAQ or Russell, is showing that money is going to the US. So do you fear dollar strength, you know, DXY towards 95, which in turn can hurt EMs?
Yeah, it's a bit difficult to say. Obviously, people are very worried about dollar strength, both in terms of having weaker emerging market currencies, because that'll reduce my returns if I'm investing outside of the US dollar, but also because of the knock-on impact in emerging markets. Our analysis would demonstrate that actually a strong dollar, as long as it's not a very sudden increase in the dollar, is not harmful for emerging markets in terms of equity performance and even in terms of bond performance. In other words, I think that emerging markets can absorb the impact of a stronger dollar as long as it is not a very dramatic increase in the strength of the US dollar. And I don't think we're going to get a very sudden move in the dollar. I think all of the drivers for a stronger US dollar have been in place for a considerable period of time. And what we've seen is the dollar moving up in value this year very, very steadily. And I don't think that that's about to change. So I don't see that as a big threat to emerging markets at this point.
Yeah, so, you know, let's just talk a little bit about where emerging markets are headed. I mean, India has gained about 1% this year, but it's underperformed a lot of other markets. What is the pecking order within the emerging market basket for you?
So we would say that we prefer emerging markets over developed, and then within emerging markets, Asia looks very attractive as a region. It has the cheapest valuation of any of the emerging markets regions, and it has the best prospects for earnings growth. So when we think about the two things that matter most to equity investors, which are the profitability and the valuation of the assets that they're investing in, both of those aspects are most attractive in Asia. And then within Asia, I think you have a lot of choice because Asia is a very diverse kind of region. You have some developed markets, you have some very large economies like China, and then you have some emerging markets and even some frontier markets. There's a huge amount of choice within the region.
All right. So where is India in your pecking order then? I didn't get that.
I think India is very interesting because India is not very cheap. So if you look at the valuation of different countries in Asia, India doesn't look particularly attractive from a valuation perspective. But India almost never does. India almost never gets really, really cheap. I think the key question for India is more around profitability. So Indian profitability has been a bit slower to recover than that for other countries in the region. It's lagging a little bit, and this year is a key year in terms of profitability for investors coming into India. They want to see a recovery in profitability. It looks like it can be delivered, and I think that's what's likely to drive the market. So I don't think that we'll get very much multiple expansion in India. It's going to be much more around what can companies deliver in terms of earnings as the driver of returns for the Indian market.
Oh yes, we have heard that slower profitability growth. I'll come back to India, but just more importantly, what's your view on crude? Do you see it? Is the HSBC in-house view that it goes over $80 or even $90?
Well, it's very hard to say. Obviously, forecasting currencies and commodities is notoriously difficult. What I would say is, from a very big kind of macro perspective, there isn't a huge shortage of oil in the world. It's not like we've got global demand running at such a strong level that we're struggling to keep up. At the very least, we have a balance between supply and demand, and more likely, fundamentally, we have an excess of supply over demand. And so therefore, it's difficult to see fundamental drivers pushing the oil price much higher. But as I say, having said that, it is notoriously difficult to forecast oil prices, and in reality, they could continue to go up before we see a stabilization, although I think at this point that's unlikely.
Okay, so back to India and to politics. Bill, there is a slim chance the current government may not win the polls next year. Will that worry you and keep you from investing in India?
No, it won't. I think obviously investors are going to be very focused on the upcoming elections in India. I think the reality is that as investors, we're less worried about the politics and we're much more interested in the reform agenda in India. And we've seen a lot of reform happening over the last few years. We've seen, I would say, 3 very important pieces of reform that are game changers for the Indian economy. We've seen GST being brought in and being implemented successfully by this government. We've seen the credit resolution environment being set up and being implemented. We're now seeing the first insolvencies, the first big insolvencies going through that process towards a very successful resolution. And finally, we've seen a recapitalization or an announcement around the recapitalization of the public sector banks. Those 3 things, I think, are absolutely vital to India. They're absolutely vital to the economy, and they're vital to the future success and growth of the economy. So I think that's what investors are going to be focused on. And if we get a continuation of the reform agenda, particularly on those 3 key areas, then I think the politics will matter less. It's really around what reforms can be delivered by politicians.